Most people have never heard of ISO 20022, and the few who have usually file it under boring banking stuff, which is exactly where it seems to belong. That perspective changes quickly when you realize that every international wire you've ever sent, every trade settlement between massive institutions, and every cross-border payment clearing through banks runs on a messaging system built in the 1970s. The world is shutting that system down. This isn't a light upgrade or a software patch. It is a total shutdown. What replaces it isn't just a faster version of the old tech, but a complete restructuring of how value moves, how we track it, and exactly what data sits inside the message itself. The migration deadline hits in November of 2025, and after that date, the legacy format simply stops working for everyone. There is no grandfather clause for slow adopters because you either speak the new language or you find yourself kicked off the network. This represents the largest infrastructure shift in global finance since SWIFT first went live, yet almost nobody outside of institutional operations teams is paying any attention. What you're about to see is the plumbing rewrite happening under the surface, which consists of 5 layers that connect into a single inescapable system. We have the data language itself, the forced migration deadline that leaves no room to opt out, and the CBDC on-ramp already baked into the standard. Then we have the tokenization bridge that lets real-world assets ride these same rails. And finally, the control architecture embedded in the whole thing. The efficiency and the surveillance are actually the same upgrade, and once you see how they fit together, you'll understand why this isn't really about faster payments. ISO 20022 is not a network, and it's not a blockchain, but rather a data language that acts as a standardized dictionary and grammar for financial messages. This allows structured information to travel inside every payment instruction. And you can think of it as the difference between sending a postcard with a few scribbled lines and sending a full legal document with attachments, metadata, and conditional clauses. The old format, known as Swift MT, was built when messages had to fit inside tiny fixed-length fields. A cross-border payment might carry a sender name, an amount, and a destination account, but the system couldn't handle much else. If a bank needed compliance data, sanctions screening, or invoice details, those had to travel separately, which often meant using entirely different channels. One transaction could spawn 18 or more back-and-forth messages just to confirm who was sending what to whom and whether the transfer was legal. Under ISO 20022, all of that friction collapses into a single structured message. XML or JSON payloads carry the payment instruction, the underlying invoice, KYC attributes, sanctions flags, counterparty identifiers, and settlement conditions in one transmission. The receiver gets everything it needs to clear, reconcile, and report the transaction without picking up a phone or firing off 3 follow-up queries. This cuts reconciliation costs dramatically, and industry estimates point to 50% reductions for banks that fully adopt the structured format. But the bigger shift is that the pipes now carry structured intelligence. Every digital asset that wants to move across borders eventually has to speak this language, because the old postcard system won't exist anymore. That's not a market preference. It's the new architecture. SWIFT established a coexistence window that officially slams shut in November of 2025. And until that moment, banks have the flexibility to use both the old MT messages and the new ISO 20022 format. Once that window closes, the legacy MT format will no longer be supported on the cross-border network. By the time we reach 2026, any institution that can't generate or process these new messages will simply lose its seat at the table for international settlements. You have to understand that this isn't some optional upgrade where early adopters get a few extra perks or a pat on the back. This is a hard cutoff that affects every correspondent bank, every payment processor, and every treasury operation handling global money flows. If these entities don't comply, they go dark on the SWIFT network, and since there isn't a backup messaging layer for international transfers, being off the network means you can't settle. The deadline acts as a massive regulatory hammer that will likely crush legacy gatekeepers who built their entire business models on the messy nature of old messages. These institutions used to charge high fees for manual fixes and reconciliation workarounds, But the new format makes those errors a thing of the past. When every single message carries its own compliance data and machine-readable instructions, the ability to profit from confusing information completely evaporates. What we get instead is a settlement process that is programmable, traceable, and impossible for a bank to slow walk for its own benefit. A payment is no longer just a simple request because it has become a full instruction set that either executes perfectly or triggers an automatic review. The old system allowed for strategic delays, but that era is ending because the message itself now enforces the timeline of the transaction. Deep inside the ISO 20022 technical specs, there is a detail that most people missed when the standard first came out. The Registry for Currency Codes already has specific slots reserved for digital currencies, and that includes central bank digital currencies. These aren't just placeholders for some distant future, as they are already sitting in the active code list right now. This setup means a wholesale CBDC transfer can move across the world using the exact same pipes as a standard dollar or euro wire. The People's Bank of China ensured the ECNY was compatible with these standards from the very beginning, and the European Central Bank is taking the same approach with the digital euro. These projects aren't just side experiments that might eventually link up, but are instead being built to plug into the upgraded SWIFT network the second they go live. The practical side of this is that a central bank can issue digital currency while commercial banks settle it across borders, using the systems they already have in place. Because the message carrying the money can also hold conditional logic, we are looking at a future where payments only execute if certain triggers are met. This allows for atomic swaps on the rails we use today, meaning settlement happens inside the message flow rather than waiting for a separate process later. The standard essentially makes state-controlled digital cash the default path for the entire financial system, rather than a niche category that needs special hardware. Every country developing a CBDC knows the messaging layer is already sitting there, waiting for them to use it. The real question isn't whether digital fiat is going to work on a global scale, but rather when each country decides it's time to flip the switch.